Low supply leads to high oil prices. High oil prices lead to high inflation, and high inflation ensures that interest rates won't just stay high, they might even climb further. While high oil prices drive inflation, inflation also inflates the capex for AI companies building data centers. This means that not only is the discount rate shifting, but initial investment costs are rising too, further squeezing long-term free cash flow. In times like these, I am always reminded of the two highly levered formulas that dictate stock market returns. 1. The core equation of asset pricing, the DCF model. The value P of any stock is essentially the sum of all future cash flows, CF, discounted back to today's value. Asset value P equals future cash flow divided by 1 plus discount rate R to the power of time t. In this equation, the discount rate R is the gravity of the financial world. 2. Deconstructing the discount rate, why rate hikes matter. The discount rate R isn't a random number. It consists of two components. Discount rate R equals risk-free rate, RF, plus equity risk premium, ERP, risk-free rate, RF, usually benchmarked against the 10-year U.S. Treasury yield. The transmission logic of a rate hike. When the Fed raises rates, the risk-free rate, RF, rises directly. Even if the risk premium remains unchanged, the total R in the denominator increases. Mathematical certainty. As the denominator grows, the resulting present value P must shrink. This is why rising rates act as a coolant for global asset prices. 3. Why high valuation stocks feel like chicken ribs in the short-term high-growth stocks have a unique valuation logic that makes them hypersensitive to interest rate volatility. A. The duration effect, exponential punishment over time. The value of AI companies is largely derived from future explosive growth, cash flows where time t is large. Observe the denominator, 1 plus r, to the power of t. If time t is long, even a tiny move in interest rate r is magnified exponentially. Comparison. A company earning $100 million today is less affected by rate hikes. However, an AI company promising massive profits only 10 years from now will see its valuation ruthlessly halved by high rates due to this exponential relationship. B. Earnings yield versus treasury yield. We can compare these intuitively using the inverse of the PE ratio, known as the earnings yield, E over P. High valuation AI stock. PE of 50 times implies earnings yield of only 2% 10-year U.S. Treasury, yield of approximately 4.5% to 5%. Conclusion. When a risk-free Treasury bond offers a 5% return, an uncertain AI stock with only a 2% earnings yield loses its luster. This risk-reward inversion makes AI stocks feel like chicken ribs, an idiom for something of little value but hard to give up. Unappetizing in the short term, yields too low, yet painful to discard. Future potential is huge. 4. The psychological game of the risk premium, ERP. When rates are high and market liquidity tightens, investors naturally demand a higher equity risk premium, ERP. This leads to double expansion of the denominator, discount rate R equals rising interest rates plus rising risk premium. Valuation compression. Even if an AI company's fundamentals remain unchanged, the stock price must fall simply because investors have become more cautious and demand higher returns. Summary. Potential rate hikes do more than just raise the cost of borrowing. They reshape the entire valuation framework through mathematical law while triggering institutional fear of missing out as early-stage gains evaporate. My task is to relentlessly seek out high-quality companies that make a 5% treasury yield look unattractive. If a company possesses immense pricing power, can it raise prices to outpace inflation? If the denominator increases by 10%, but the numerator, future earnings expectations, jumps by 50% through the aggressive application of new technology, then gravity is offset by momentum. I believe the market will always offer companies where momentum defies gravity.